Hi, everyone. I'm Diane Brady. I'm here with my colleague, John Dobosz, who, of course, edits the Forbes Dividend Investor newsletter, as well as, John, the Billionaire Investor, FBI. So go check it out. Well, let's just start with the general environment right now. Inflation, we've got the debt ceiling, still insecurity. What are you seeing?
Last time we spoke, just before the new year, we were looking ahead to what seemed to be a tricky time for investors, but really it's been kind of a party for the first 3 weeks of the new year. A lot of worst to first phenomena happening in the market. The tech sector was about the worst place you could be. Tech and consumer discretionary stocks were the worst place, 28 to 33% down last year. Who do you think the leaders are? Tech. Tech's rebounded. Every day you're getting headlines of 6%, 10% job cuts at Alphabet, at Meta, at Spotify. My reaction when I'm hearing a lot of this is, how did those companies ever have that many people in the first place? But Wall Street seems to have really cottoned on to the idea that they're getting leaner, meaner, and more competitive for the future. And it's not unheard of for look at energy 3 years ago, 2 years ago, worst to first. And it's happening again, but this time with technology. Well, dividend paying stocks, which were so nice.
Prudence, right? That's investors do like to see some fiscal prudence, and job cuts can mean you're
like to see it, but I don't think we've seen it for about 26 years. And we've lived on, we've soldiered on somehow through 3 or 4 bear markets and 3 or 4 bull markets since 1997 or 1996. No, this debt ceiling, it's kind of like Jaws. You saw the first movie, that not everybody dies. Sheriff Brody will live on. Then Jaws 2 comes along and blah, 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 blah. So back in 2011, the Congress waited until the very last minute to pass an extension to raise the debt ceiling. It was already too late for the credit rating agencies, the guys who certified all that junk paper as investment grade back in 07, 08.
And they
consider your source. They downgraded the U.S. debt, and that precipitated a 19% correction in the S&P 500 index. But the market was not spanked going into that. I think you could agree we all got a spanking in the overall market, down about 19% for the S&P last year. So yes, it could come to a head. It could get nasty. But I think that, the boy who cried wolf cried it too many times. We've seen the movie before. We know how it ends. And if there is a pullback, you go in there with your shopping buggy and you put everything in it.
Well, I want to talk about that shopping bucket because your latest newsletter, you have a 6-pack of, let's go through the 6-pack of new buys for Forbes Dividend.
Each week I'm looking for, and I don't turn the portfolio over radically, but there are times when things look good, and a lot of things look good. Last week, there were 6 stocks that are classic dividend payers that probably belong in anybody's long-term portfolio. One of them was Lockheed Martin, LMT. They, of course, make military aircraft and other weapons. Yes, the government shutdown would certainly affect a defense contractor, but I don't see a world that will have an absence of violence or the need or no need for military aircraft.
Was it sent down because of fears over a shutdown?
Yes, that certainly did. I remember in October when everything was looking cheap, and it also looked like we were going to go a lot lower, and the fear gripped the market. It was down around $390, and it zoomed all the way up to almost $500, and it's back around $440 and change right now. I don't know if you're a fan of the Italian mathematician and rabbit raiser Fibonacci, but
I will be.
Fibonacci numbers and the Fibonacci retracements are big in technical analysis. So that 110, 120 point move roughly it has been halved for Lockheed Martin. So it's not a huge yield that will bowl you over. It's about a 2.8% dividend yield, But like I say, it's one of those great American dividend stocks that you always want to have. A couple of real estate investment trusts came in there. Real estate investment trusts are special kinds of stocks that they invest in real estate. As the name says, REIT, REITs, and they have to pay out at least 90% of their net income to shareholders. They don't pay tax on that amount, but you as the shareholder pay taxes. But at least the taxes are not double taxation. So it's not taxed at the corporate
Capital
level, it's
gain.
taxed at your level. They're priced for their high yields and predictable dividends. So two of the ones that we picked out were Digital Realty Trust, that's DLR, and they are the largest owners of data centers in the United States. Data centers are kind of like the steel mills of the 19-teens and 1920s. You know, you can't do anything really without having massive amounts of data. And Digital Realty is the
Suddenly
major.
trying to remember when Bethlehem Steel went under. So it was still good to be in the steel mills back in the 20s. Correct.
Shall I mention to you one more of the REITs?
Yeah. Talk about the REITs and also where they're focused, if it's commercial real estate or particular parts of the country, because I'm sure that factored into your choice.
Digital Realty has a very heavy presence on the West Coast, Rocky Mountains, and the East Coast. So basically anywhere people live. The other one from the real estate investment trusts that we recently added was National Storage Affiliates, just like the National Security Agency, NSA. No matter where you live in America these days, you're probably no more than about a 4 or 5 minute drive from about 3 or 4 self-storage facilities. I don't have one, but a lot of people do apparently. Maybe it's drugs, maybe it's people moving, maybe it's a cheap place to live. I don't know, but the sector has been strong for the past 15, 20 years. Dividend yield approaching 4% for NSA. So those three, check them out: LMT, DLR, and NSA. Those are from the Forbes Dividend Investor.
And of course, if they want to get it, they should sign up for the...
Sign up. Actually, I don't have a quick, easy link for that one, but any browser that you Google Forbes Dividend Investor, you're going to get to us. But we do have a cool little URL, Forbes.com/FBI, like the Federal Bureau of Investigation, but it stands for
Billionaires.
Forbes Billionaire Investor. So Forbes.com/FBI, check that out. And you want to talk about some activity among billionaire investors? Because that's what we do.
Yes. Where are they putting their money?
Well,
making their money.
It was reported that Paul Singer from Elliott Management, one of the, he and Carl Icahn are kind of the prototypical, not corporate raiders, but
corporate shareholder activists, I guess, right?
Their MO is to acquire large pieces of a company, get influence, get seats on the board of directors, and go in there and agitate for change to help unlock shareholder value. And the latest target for Paul Singer and Elliott Management is CRM, Salesforce.com, Mark Benioff's company. There was a departure of his co-CEO about a month ago or so. That sent the stock down. They knocked down their estimates. It sent it down a little more. They fired some people. And Elliott is in there, or I should say Paul Singer is in there, trying to bend the ear of Mark Benioff to make further changes, which he think will be beneficial for shareholders. So
let's step back a bit, because I'm fascinated with the shareholder activists. Some of them can do incredibly well, and I know Carl Icahn has had a great track record. And then there are moments where it becomes a little bit more of a personal agenda. I'm thinking of Bill Ackman with Herbalife. And what is the modus operandi? Is you have to buy a certain large stake. What is the stake that Elliott Management has taken at this point that gets you noticed by management?
Each quarter, if you manage more than $100 million in assets, you have to report your holdings to the SEC on Form 13F. And that's where it came from. Honest to God, I have no fucking clue what Singer owns right now. I could tell you in a moment.
Well, what's interesting is really the genesis of this, because some of these battles become public. Some of them are very much behind the scenes, and it's just influencing management. You mentioned the turnover, especially the leadership turnover, not just within Salesforce, but some of the divisions like Slack, Stuart Butterfield has stepped back. So is that the genesis here of what has attracted the interest of Elliott Management?
Elliott is just a great, best-in-class company that has fallen on some hard times. And I don't know the specific ideas that he has yet about what needs to be done. Sometimes these campaigns by activist investors are wrapped up very quickly in a few weeks, and they say, "Oh, I'm very happy. We have the cooperation of the board and the CEO, and blah 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 blah," and they fade off into the sunset and quit making noise, and then their shares appreciate. Sometimes an activist investor will get into a situation where the company maybe is not savable. Despite all the pressure and buttons they can push, you still can't make a horse produce or a cow produce Coca-Cola.
That does not seem to be the case with Salesforce. Not that I'm on the marketing team here, but it does feel ubiquitous, and it has had a successful run from a profit point of view.
I think you're right. Like I said, it's a best-in-class, whatever you call it, workplace solutions company, enterprise resource management, that kind of stuff.
SaaS, sure. Yeah. So talk a bit about what to expect from here. First of all, sometimes when a shareholder activist goes in, it's a signal for the rest of us, not me, of course, since I don't invest in these stocks, to go in as well. Or is it sometimes a signal that it's too late and to let it play out?
No, not at all. I think you can make a very good living if you follow very good investors into positions that they own. In many cases, most cases, they're not in and out in the same day. They're not day trading these things. They might be swing trading them. And there is the danger, of course, that the 13F, which only needs to be filed every 3 months, might be a little bit stale with its information by the time you receive it. So in the Forbes Billionaire Investor, what we do is look for clusters, of several billionaires who are going into a stock. And if they all have different methodologies and different criteria for what constitutes a good stock, if you see that consensus of opinion, and then you do your homework a little bit more on, not that we know any better than,
Well, we see patterns. You see patterns. You're watching.
You see patterns developing. You're like, oh, well, there must be something there. And yes, so no, I don't view as seeing a guy go into a stock like Singer is with Salesforce.com and say, oh, good for him, but it's already jumped on the news. I don't want, it's too late for me. No, not really, because if what he's doing works out, the returns will be a lot better than what you've already seen.
Is there a cluster of activity here? Because to your point, oftentimes I'm thinking Dan Loeb, David Einhorn, there are many players in this space. They watch what each other does. Sometimes they'll take the opposite stance, and sometimes it's an ego game. To what extent are we seeing other billionaires interested in Salesforce as a investment proposition?
Ken Fisher from the commercials, You Do Better When We Do Better, or vice versa. Fisher Investments. Fisher Asset Management still has almost $2 billion worth of stock, but in Salesforce. But in the last quarter, they sold off almost $3 billion worth. So maybe he'll be coming back into it later, but that was probably a good move by Ken Fisher to get out of Salesforce before it I don't know if you want to say it tanked. Yeah, it tanked.
What does tanked mean? Give us some perspective on how Salesforce is done.
Well, over the past, let me pull it up for you, show you exactly, CRM. Back in August, it was at $190. It got down to $130, and it's actually back up to $155. If you pull it up, nice little jump since the beginning of the year. And it's back above its 200-day, it's back above its 50-day moving average, chugging in on its 200-day. So, but even earlier, let's see, 1 year ago, we're talking about, I think it was over $200. Yes, oh my gosh, yes, it was. Well, talk about what is tanking. Okay, Diane, here's what's tanking. Back in November of 2021, Salesforce was above $310 per share. And in December, it got down to 125, and it's back up to 155 now. So we're talking about a decline still of 50% from its highs.
Sometimes these drops can be enigmatic. Sometimes they can be very explicable. I mean, Tesla had a remarkable drop too, and I think that it's somewhat easier to target some of the pivot points there that disturb people. Was there anything specific about Salesforce that kind of got people nervous?
Well, the entire tech sector was going down that same sliding board in 2002. And the departure of the co-CEO last fall certainly didn't help.
Right.
It down to its final lows. But I guess Salesforce is like any of those big tech stocks that seem to be able to do no wrong for so many years. And they were full of people making, $400,000 to be content strategists or whatever they do.
One thing that intrigues me, I was looking at, speaking of billionaires, Ken Griffin's Citadel had a record of 16 billion profit last year. More generally, how have the billionaires done? Was it a good year for them?
Well, it depends who you were. Ken Griffin certainly has had a good year. He's had a good 30-year period. Over that period of time, he's made $66 billion for his investors. That's a little over $2 billion per year. And he's definitely the king of the road right now.
If you were to characterize his strategy in this environment, you're a big person who, listen to me. You are one who is very much an advocate for defensive stocks in this environment. Was that really the strategy that paid dividends, no pun intended, last year?
Well, yeah, last year that was the place to be in conservative value stocks, those with high dividend yields. But if you wanted to characterize the strategy of Citadel and its head man, I would say that Griffin is a quantitative investor, he looks at stocks, not just the technicals, not just the fundamentals. He creates models that tell him what a good stock looks like. And it may change from time to time.
Connecting the dots in many ways. Yeah.
In fact, we recently added a couple of stocks that Ken Griffin is also into in the Forbes Billionaire Investor. Like I told you, we were trying to go for clusters of billionaires. Now, here's a good lineup. And I know people generally aren't big fans of George Soros, but Soros he's been doing it. He's one of the OGs of this business. He was one of the first to operate a hedge fund. And anyway, so Soros, Ken Griffin, Stephen Cohen, who owns the New York Mets. You might know who he is. Mario Gabelli, he's been around a long time. Israel Izzy Englander, he is from Millennium, which is one of the top hedge funds in the world. And Cliff Asness of AQR Capital Management. So you've got these 6 prominent billionaire investors who have all invested in a stock that they hope not to lose their shorts in. No pun intended, or actually very much intended. The stock is Hanes Brands, HBI. And if you don't know what Hanes underwear is, yeah. So Hanes was $21, over $21 back in April of 2021. It got down below $7 recently. And we're back above $8 per share now. And it's got a dividend yield that's just below 8%. You look at the stock, and here's an interesting thing to consider, and it might freak you out or just give you a sense of challenge. The biggest competitor to Hanes Brands is Fruit of the Loom, which since 2002 has been owned by Oracle of Omaha. Exactly. Warren Buffett's Berkshire Hathaway. So if you're
I
buying
was wrong,
Hanes
actually. So I said Warnaco, which of course is affiliated with Jeffrey Epstein. And so let me step that back. So it's owned by Warren Buffett. So clearly a value stock.
Buffett's team bought it back in 2002. Last year was a pretty bad one if you were in the underwear business, because commodity costs, supply chains, and all that, cotton costs were through the roof. And they've had competition from other companies like Gildan up in Canada. Being a good Canadian, you might be aware of them. GIL, I think, is their ticker symbol. But Hanes Brands, it's one of those stocks I've always looked at and gone, oh, it's burned me before. I'm not going to. And then we saw these billionaires involved with it. So Hanes Brands looks like a very nice stock to get into with all these billionaires into it. Another one that Ken Griffin recently got into, along with Izzy Englander, Cliff Asness, and the family of a deceased billionaire named Fayez Sarofim, is Ball Corporation. If you're a basketball fan, you might like to watch the Denver Nuggets play at the Ball Arena in Denver. Ball is based out there in the Denver area. They are the biggest maker of metal cans in the world, and that could mostly for beer and soda, but also for things like peas and corn niblets and things like that at the grocery store.
Them. That's interesting.
Not really a huge dividend yield, but 1.5%. But Ball has been around since the late 1880s. Their first big success, if you will, was the Mason jar, which fell out of patent protection in 1879. And at that time, just about everybody in the country had a garden in their backyard and were canning goods. And the Mason.
So let's go back to the 30,000-foot view to end, John. What signals would you be looking for in the environment right now as an investor?
Well, we got a pretty good signal in terms of market breadth, BREADTH. Market breadth refers to the number of stocks that are moving higher versus moving lower. So a ratio above 1 means you have more stocks gaining than losing. And that ratio very rarely gets above 1.7. It's only done so 25 times since 1946. And in 23 of those 24 years, the S&P 500 was higher for the full year. When this occurs in the month of January, and we just had it occur this January. So that's a pretty powerful signal. We've discussed before, and it's still true, that it's very difficult to prognosticate a recession, but there are so many signs, from the inverted yield curve to the index of leading economic indicators, purchasing managers indices on the services and the goods side. Everything except for unemployment pretty much is flashing danger. But we still have a chance for it to resolve. The Federal Reserve, one thing that's definitely true is we are closer to the end of their tightening campaign now than we were last year. They've done a lot of the heavy lifting. The market expects the quote unquote terminal Fed funds rate to be 5.1%. And we're already at the almost, the 4.4, 4.5 right now. So 3 more 25-point rate hikes at their next 3 meetings would do the job. And many of the Fed governors and the FOMC members, half of which are women, by the way. Did you know that 6 out of the 12 members of the FOMC
That's
are
heartening.
Yeah,
very
no, I thought that was very.
Their fears of inflation maybe have abated somewhat.
Well, they should be abating. I mean, that because the actual inflation rates have been abating for a while now. Consumer, in December, consumer prices fell 0.1% from November. So we're going in the right direction. We're nowhere near the 2% level that the Fed says that they need. But, they're probably a very tough talking parent who doesn't tell the kids, you're going to go to your room if you do that again. But if the kid does it again, they'll be a nice, loving parent. We'll see about that. But I think that the fact that the market has already sensed some kind of a turn, as expressed in that really positive breadth indicator that we received in January, we might be good to go for a few more months at least until the hurricane hits.
Continue to do my index funds so we can speak freely about all this. But thank you again for joining us, and look forward to the next time, John.
Thanks, Diane.